And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
On Canberra Live with Leon Delaney, Money Matters with Luke Smith from Envision Financial Services.
It's all about perspective, isn't it, Luke? Glass half full, glass half empty. It's partly cloudy, it's mostly sunny.
I'd take blue sky, no wind and cold over wind and anything else. So you're right. It just depends how you cut it.
Oh, yeah, exactly right. I don't mind the cold weather so much, but when it's horribly windy, that's no good. When it's wet and miserable, that's no good. But
No, I can take blue sky, still, and a fresh, cold Canberra morning.
Beautiful.
Lovely.
Yeah, lovely stuff indeed.
Yeah, the wind, you can keep.
Now, today we're going to take a look at an issue that often comes up. People getting confused about the income and asset tests for Centrelink payments.
Yes.
And it's a tricky one because it's a little bit complicated, isn't it? Yeah,
look, I think this has sort of been a little bit prevalent of late, so I thought we'll just hash this out because there are some weird and wonderful assumptions out there about what counts, what doesn't count, and how it works. And if we sort of use that as a good segue, the two tests that we're talking about are an income test and an asset test. And you are assessed on both. Now, depending on the assessment that gives you the least by way of entitlement, that is the test that Centrelink will use. So, for example, at the bottom end of a couple's asset test, they can have just shy of 500 grand and be entitled to full age pension. Now, on the other end of that spectrum, if you have over 1.1 million, you have too many assets to get anything. And if you're anywhere between those two figures, from 500,000 to 1.1, you get a prorated entitlement that decreases by a specific formula.
Yes.
So when people want to say, well, what will I get? First, we need to separate what are the assets that I have that are assessable. And that's basically any financial asset. That could be money in a bank, could be an investment property, it could be a term deposit, it could be superannuation, it could be a pension account.
Do they go to the trouble of adding the value of your car and your personal effects?
So as part of the home valuation, we're talking fire sale value of contents and, yes, motor vehicles and other toys. So value of a caravan, for example. So all of that gets added up into the asset test. And then what happens is they turn around and say, okay, we will assume a rate of earnings on that amount of financial asset.
But my motor car doesn't make any earnings. That's not fair.
And that's fine because that's not part of the deemed asset because it's not a financial asset.
Right.
But it adds towards the asset test threshold.
Right, okay.
Okay, so we go...
So it's even more complicated than I thought.
We go toys and contents, and then we go financial assets.
Right.
And you might have $700,000 of superannuation between the two of you. They will assume at a set rate that $700,000 earns an amount of money. And that gets added to your income test. So telling them the truth about your financial assets matters. Considering when and how income streams are commenced matters. But we need to keep in mind that they are interlinked, but they are assessed separately. So you could go, and this one gets a lot of people, well, I'm under the asset test, so I'm going to get a full pension. Oh, but I've got $100,000 of income over here. And that's more than the income limit, so no, you're not going to get anything. A lot of people seem to think that, well, if I pass this one and fail that one, I can still get something. We got to remember, it's the test that gives you the least amount of benefit is the test that they use. So we have an asset test and we have an income test. The income test would include the deemed income from the assets that you have, rental income from a property, and any other form of income or pension that you receive. That would include a defined benefit pension like CSS and PSS here, or part-time wages. If you did 2 days a week work, okay, you're going to have wages plus maybe a pension from your previous employer, like a defined benefit, and then some earnings from the assets that you have. One thing to clarify is the rate of pension you take does not impact the income test. A lot of people say, but I take 50 grand of pension out of my assets. They're going to add that to the income test. They don't. They use the deeming rules to assume a rate of earnings. Anything you take in addition to that doesn't matter. So we have income from multiple sources. What's my assessment? I have assets on this side. Where am I on that sliding scale? Just shy of 500,000, get full pension. Just over 1.1 million, get nothing. And the same applies with the income test, which is, just over, for a couple, just over 100 grand. And anywhere in between, you get a prorated amount. And that's why the disclosure of assets is important. Now, some things to keep in mind. The assets of a Centrelink entitled individual count. The superannuation assets of somebody under pension age, not in pension phase, does not count. So if I was 67 and my wife was 62, it would be highly advisable to not have a lot of superannuation in my name. Because if it's in my wife's name and she hasn't started a pension, it's invisible in the eyes of Centrelink. So that would be a good way to bring down your assessable assets where there's a difference in age and one of the two of you has got to pension age. Now, when my wife finally gets to 67, all of the assets in super and or in pension are then on the table under the asset test. So if you've married well and there's a few years between you, think about having assets in the younger person's name, not in a pension, which means they could be over 60, have retired, and be able to access money as a lump sum. That would be advantageous for you from an income perspective. From an asset test or from a payment perspective, also remember that the gifting rules allow you to give away $10,000 a year. Anything over that, they will assume that you still have it under the asset test. Because a lot of people say, well, I'll just give my kids 100 grand. I go, well, you can do that, fine. Is there any tax implication? No. But Centrelink will assume that you've got $90,000 for the next 5 years under that deeming rule that I made and talked about before. And it would fall under the asset test of what you have. So this isn't their first rodeo. You getting to pension age isn't the first time they've come across that. But again, the gifting rules say if you give away more than $10,000 a year or 30 over 5, that anything above that is counted as an asset. So if you're 62 and know you're going to be eligible, you'd want to be giving away big blocks of assets well before, because they'll ask you when you fill out your paperwork, have you given away anything in the last 5 years? No, I haven't. Now, there's pros and cons to doing that. You need to consider your personal situation, but that's something that people need to think about. The family home does not count under the asset test. I get told 3 times a week that now it does because the rules changed. It doesn't. Investment assets and campsites and all these other things that are financial assets, yes, they would. But your primary residence is exempt and it doesn't count under any test. However, if you do have, let's say you had some boarders in your house, you had some people renting some rooms, there's some income that you need to be declaring under the income test. So it's important that people understand that they're 2 different tests. They're measured differently, but they both get you to a point where they can make a fair and reasonable assessment of your financial situation.
It's an extraordinarily complicated minefield for people to navigate, and I'm sure people could use some clear-cut advice as they do attempt to work their way through it. But if you're concerned about maybe not quite qualifying for an age pension, are there steps that people can take to legally reduce their assessable assets or move money around so that they're better off?
Yeah, so you can use a few different types of income streams. So you can consider a lifetime income stream or a pooled income stream. In special situations, you could also then consider a special disability trust. Let's say you had a child that had special needs or needed some assistance. A special disability trust allows you to put money into that vehicle, and the money that goes in there up to a certain threshold, which is about 850 grand off the top of my head, is exempt from a Centrelink standpoint. You could also then look to use an annuity where a portion of the capital put into that annuity is assessed under the asset test. So there are a few different ways that you can sort of manipulate what's recorded. But again, you need to weigh up the pros and cons of each of those options, because they don't come without risk, and they don't come without certain rules and certain caveats as to how you operate and how you use them. So I think it's important to make sure that you're doing something that is applicable to your financial situation. If I was over and needed to get under the asset test and went and undertook some amazing renovations to my primary residence, great, wonderful way to bring down assessable assets and improve an asset that could go up in value over time, but also maximise my enjoyment of the family home whilst you live there. So there are a number of things that people can consider. It's just making sure that across the broader approach of how I'm going to manage my assets, it's working for you from an access perspective, a liquidity perspective, and a cash flow perspective. Because if you did turn around and say, well, I'm going to give my kids $300,000 5 years out, who's to say the kids don't go to Coachella and light it all up, and you go in one day and go, hey, can I have that money back, please? And they go, what money? Oh, but you said you would, what money? So nothing's without, broader financial consideration. But I think it's very important that you do the right things for the right reasons, maximise the availability of the rules and regulations in relation to Centrelink, and get the best outcome possible. And just remember that if you fail once, it doesn't mean that you can't have it forever. You have the ability to go back and have your situation reassessed so that you may be entitled to something, especially if you're right on the cusp and you said, all right, in the next 2 years, we're going to have some amazing holidays, do some amazing renovations to home, and go back in $300,000 lighter on the asset test. You might fall under the threshold, because the thresholds also continue to index twice a year. So the assessable value of your availability continues to grow. So don't be disheartened that you may not be there now. Keep in mind that as your situation changes, you should always go back and get reassessed.
Luke Smith from Envision Financial is with me in the studio, and we're talking about the difference between the Centrelink income test and the asset test and how the two operate together. Luke Smith from Envision Financial is with me today, and we're talking about the assets test and the income test for Centrelink purposes. Yep. They're two different things, but they do have connections. They are operating in tandem, and they can be a little bit confusing to navigate. So what are the key points people need to remember?
Yeah, so again, like we say, two separate tests, test two different things, but at the end of the day, you need to remember that the test that gives you the least is the one that they will use in relation to your entitlements. Family home is still exempt, contrary to popular belief this week. I was told a number of times that now it counts. It doesn't. Halbo's made some really silly decisions, and he hasn't touched that yet, so let's see how long that
Fingers
lasts.
crossed.
Yeah, exactly. You can continue to work if you want. The other one I also get told is, I'm working now, I can't get Centrelink. Again, where do I sit on the income threshold? From, I think, $6,000 minimum to about $100,000 for a couple. Where do I sit in the middle? If you are smack bang in the middle, then think about, I will get half of a normal entitlement because I'm halfway up the scale. All right, and the same goes for the asset test.
But there is that lower threshold where you can work a little bit and it makes no impact at all.
That's exactly right. They give you an allowance on a weekly basis in relation to income, and then that doesn't affect the assessment of your entitlements. And again, it always comes back to, where do I fit on this sliding scale? If you have assets that are too much, whether it's asset or income from a cash flow perspective, just because you fail once doesn't mean you failed forever. I had someone tell me today, now I can never get it. I'm like, well, no, that's not the case. You just can't get it today. So do some renos on your house, have a couple of amazing holidays, burn through some of this cash. If that's your burning desire to be eligible, okay, great, go and do that. Remember that assets in superannuation for a younger spouse, not in pension, are exempt under the asset test. So that's one that you can really take advantage of, and it does not fall under the gifting rules. So you can move assets between spouses. It does not trigger the gifting rules because you've given away more than $10,000. Oh, I can't do that. Yes, you can. Assessable income is deemed income and then income from any other source. Wages, boarders, rental income, that all matters under the income test. Don't assume that just because you failed one, you passed the other, you're going to get something. If you failed one, you have failed. Okay? And I think if people keep that in mind, they'll be able to make sure that they can go into it. Now, I also say this. It is a nuclear punish of an exercise to fill these things out. So make sure you're very clear when you go in there and ask for some booklets, because there will be a number of different booklets you need to complete. Too often people come in and go, oh, here's my application. And I go, where's your income and assets booklet? Oh, they didn't say anything about that. So make sure you articulate the best you can what you have in relation to superannuation or a pension, because there's nothing more frustrating than someone coming in with one book and then finding out they've got to go and get another one and come back, because details matter and they're going to want a range of different things. It is a very thorough process. It is an onerously difficult process, but as long as you go into it expecting it to be an absolute nightmare from a time and an effort perspective, you won't be surprised when people come in and go, oh, this will just be a 10-minute job. They get really frustrated because of the depth and the detail involved. So manage your expectations and you'll get the outcome that you need.
Okay, so where can people get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube where you can watch the show over and over. And we've got Smart Money Strategy, your ultimate guide to financial planning, that has an entire chapter on Centrelink and both tests.
Fabulous. We'll have you back in the studio again next Friday afternoon at the same time and we'll talk some more money matters.
Will do.
Indeed. Thanks very much. Luke Smith from Envision Financial back again at the same time next Friday.